Good afternoon, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Presenting for us this afternoon is Lindian Resources Chief Executive Officer Alvain Vorster and Executive Director Trevor Matthews to provide investors with further details on the feasibility study results for the Stage 1 development of the Kangankunde Rare Earths project located in Malawi. Questions can be submitted either through the questions pane in the control panel or by emailing me at alex@investorstream.com.au. I'd like to point out many of you have already taken that opportunity to submit questions ahead of time, which is greatly appreciated. You can also download a copy of the presentation either from the ASX platform or by navigating to the handouts pane in the control panel. Finally, a copy of the webinar will also be available on Lindian's social media platforms and website later today. But for now, I'd like to throw it over to Alvain to kick things off for us. Alvain, the floor is yours.
Thank you very much, Alex. Thank you for the opportunity, audience, to present the Kangankunde feasibility study results. Most of you will know that Lindian has excellent assets in Guinea, in West Africa, and also in Tanzania, in East Africa. But clearly the focus of today is to talk about this incredible Kangankunde project in Malawi. On this first page that you see there, you see the Kangankunde hill. That's really the heart of our project. That is where we will create the vision of a very, very significant, a very large rare earths project going into the future. So really today I would like to leave you with three messages. The Kangankunde feasibility study results were excellent. It was absolutely outstanding, better I think than what even the experts expected. Secondly, we are very confident that these feasibility results will support our funding task in the next few months. And I will talk a little bit more about that later. And thirdly, very importantly, this is stage 1 development, and we have very ambitious plans to make this a much, much larger project, given the fundamentals, support, and expansion. So those are the three key messages I hope I can clarify and bring across clearly to the audience today. Thanks, Alex. There's a slight delay given that I'm in Malawi currently, and the connection optimum at the moment in the accommodation where I am. This slide is basically just why are we talking about the rare earths industry? Again, there are many themes and trends supporting a demand increase in the future that we list there on the left. The users, I think most of the audience will understand, primarily rare earths used in magnets, in high quality permanent magnets. And then the applications are mostly in high rotation devices, like jet engines, electric vehicles, wind turbines, even Dyson hair dryers and so on, high rotation devices. It's important that we all remember that currently more than 66%, more than 2/3 of world supply produced the mining of rare earths in China, and 95% of rare earth separation happens in China. So clearly the Western world has been asleep in this industry for more than 3 decades, and now suddenly the Western world is waking up to the strategic importance why we need an independent supply source of rare earths as well. Thanks, Alex. The blue image on the screen is just a reminder again to the audience, the assets that Lindian own. And then on the right is obviously the Kangankunde project, southern part of Malawi, surrounded by Mozambique and particularly Zimbabwe on the southwestern side. Our chairman, Simwe Kabangu, and myself met with the Minister of Mines and other senior officials in Lilongwe on Monday, and we're continuing that today in the Kangankunde area itself. We're visiting the project site. In fact, right after this meeting, we are having a big community meeting. I'm suitably impressed with the support that we are receiving from the government and from the local communities. They are very friendly, they are very open, and they welcome a development like us. And a reminder that we have secured all tenure and that we have secured all approvals needed to move this project into construction and operation. It's also important that we keep in mind Lindian has only secured this project 2.5 years ago, after years of negotiations by our chairman and our largest shareholder with the then vendors and the government of Malawi. Since then, a really small team of subject experts developed this project to the point of us delivering this outstanding feasibility study this week. And I must acknowledge, the role that all these team members played, whether they were internally with Lindian or the expert consultants that we used. A remarkable feat achieved by a small team at a fairly low cost. So, kudos to them. On the next slide, thank you, Alex. The next slide really presents the summary of the whole feasibility study. There's a lot of numbers and diagrams there, but starting on the left side of your screen at the top, again, what supports a company like us going after a project like this? We have to be confident that there's a strong growth in the market, and we see 2 times demand increase in the next decade, 3 times demand increase in the next 2-3 decades. So we are confident about the rare earth market. The feasibility show we can produce in the stage 1 around 15,300 tons per annum of rare earth oxides, or of concentrates, of concentrates, of which more than 8,000 tons of that will be rare earth oxides. 45 years of mine life supported by the current reserves, and we are confident with our approval timeline, provided we can secure the funding in the next 2 or 3 months, we can actually produce the first concentrate within 15 months. Importantly, the financials for the project, often one of the highest priorities, of course, to see for investors, a post-tax real NPV in US dollars of $555 million, which is more than 800 million Aussie dollars, and the pre-tax numbers in the same order of 800 million. So very, very healthy net present value. 80% IRR, better than most of the mining projects that I have ever been involved in. The capex, very low capex, lowest that I think any of the rare earth developing companies have published recently. And the OPEX, again, I have not seen any other rare earth company with a C1 OPEX of 290 per kilogram real, and all-in sustaining OPEX of $3.70 per kilogram real, which is well below the current pricing of NdPr in the market. So that is a very, very big positive for this project. Thanks, Alex. Next one, thank you. I'll briefly touch on the resources and reserves. Most of the audience will understand the resources. Published that quite a while ago, 260 million tons at 2.14, which really, if you do the maths, that is more than 5 million tons of rare earth oxide in that resource. As I said at the previous webinar, that is probably more than what has been produced, the rare earth oxide units that have been produced in the last 30 years. So it is a massive ore body with upside potential. The ore reserves that we are publishing now, together with a feasibility study, then is 23.7 million tons at 2.9% rare earth oxide grade. Again, a massive reserve base that we can drive the 45 years of production. The image on the right is just a picture of a rock sample from site, arguably higher than average at 11.1% total rare earth oxide content, but it gives you an idea of the monazite rocks that make up the vast majority of that Kangankunde hill that we are mining. Thanks, Alex. I'll now talk a little bit about the mining and processing. We are planning to develop Kangankunde in 2 stages. Stage 1 will be about 450,000 tons per annum plant production, delivering around that 16,000 tons per annum of concentrate that I spoke about. I'm confident stage 2 can be 3-4 times higher given the resource endowment. The mine plan identified 6 areas to mine and blend from. Mining will be very simple. It'll be an open pit mining operation, simple standard blasting. We will have 1 or 2 60-ton excavators, so not the size as in the big iron ore companies or coal companies. We will probably only need 4 50-ton trucks for haulage, and they will then haul the ore about 2 kilometers downhill to the stockpiles. So again, all of that tells you, low cost if you look at that configuration. Due to the nature of the ore body, the waste to ore stripping ratio will be less than 0.2 to 1. 0.2 to 1. Now, if you look at most other rare earth projects, and they're talking about 4 to 1, 6 to 1, and there's even a 10 to 1 in Western Australia. So a 0.2 to 1 is just exceptionally low waste to ore strip ratio. Thank you, Alex. In terms of processing, this is obviously a technical slide that sets out the flow sheet. But what it is illustrating is a few very basic process steps. The 440,000 tons per annum will be fed into that crusher. About 200 millimeter size rocks will be crushed. It will then pass through various screens, multi-gravity separation, what we call MGSs, and finally a magnetic separation circuit where the remaining magnetite particles in the monazite rock will be removed. At a late stage, we added a very small spar bar size flotation circuit at the end, and that is really just to remove the last bit of sulfides from the concentrate, making it an absolute premium concentrate product with very low radioactivity, again competitive with some of the lowest radioactivity rare earth projects that I've come across. The limited use of reagents in this process will mean lower cost, and very importantly from an environmental point of view, it will mean cleaner water for recirculation in the recirculation water dam. And smaller tailings facility, because that's often the use of water creates huge tailings facilities. So this is a big cost plus and an environmental positive for this project. Thank you, Alex. The next slide shows really the inner workings. It's a 3D diagram. We have the whole plant design to nut and bolt level modeled in a 3D CAD system. And this demonstrates, if you start from the far right, moving to the left, basically the same flow sheet that you saw on the previous slide, from the run-of-mine stockpile, the classifiers, grinding, the gravity separation, magnetic separation, and then you get the product dryers that I will talk through in the next few slides. Thank you, Alex. The support infrastructure is always a very important part of any project and often overlooked. We will have a low power usage, about 3 megawatt grid power connection. It's hydropower supplied by the main power supply in Malawi, and we will have a backup diesel power generation at site. The water is sourced from the bore fields at site. Tailings we talked about, and then there's the other support facilities like admin and warehousing and fuel. About 200 to 250 people during the construction phase at site at any time, and about 100 to 150 people, depending on our rostering system, during the operational phase. We are absolutely committed to recruit locally as far as we can, and then fill up the balance for some specialist roles by fly-in, fly-out. We plan to accommodate the people in the nearby town, about 20 minutes drive away from site, the town of Balaka, where we will rent units for the owner's team to be accommodated. Thank you, Alex. In terms of logistics, apologies, the product summary is really at the heart of the feasibility study. You will see there two columns. The one is year 1 to 5 annual average. Very important, because sometimes year 1 to 5 have very different production parameters and also economics than the life of mine. So we decided to split it in these two columns. So year 1 to 5 and life of mine. Annual tons mined, you'll see there, life of mine 450,000 tons. Concentrate production about 15,300, a bit higher initially, given that we are mining a slightly higher grade of the ore in the earlier phases. You'll see that the average grade milled 3.3 in year 1 to 5. And then you get the 8,300 to 8,700 rare earth oxide per annum, which gives you the 1,600 to 700 NdPr in concentrate. Reminder, that is what we actually get paid on in the end. Thank you, Alex. In terms of the logistics, the concentrate product will be dried to around a 2% moisture. It would be packed in 1-ton bulker bags at the Kangankunde site. On that left-hand diagram, there's a packing shed. The bulker bags will be transported around 110 kilometers to an area called Limbi, very close to Blantyre on that map on the right-hand side. It will be transferred to a rail and then railed for 650 kilometers to the Nacala port in Mozambique, also shown on that map on the far right. And then there's ocean freight, of course, from Nacala to the final destinations. So unlike many projects, in areas with limited infrastructure, we have very good sealed roads, rail and port facilities to rely on immediately without us spending any capital on that. Thank you, Alex. Now I'll cover the capital and operating cost. Very importantly, the capital cost is what we call an AACE Class 2 estimate. That is a feasibility, a definitive feasibility level estimate at 15% accuracy. and engineering completion 60 to 80%, depending on the specific area of the project. So there's clear definitions around that, how it is classified. You'll see the different areas there. Clearly, the process plant is the largest component of the direct cost. Direct cost is around $30 million. The indirect cost around $10 million. Total cost just short of $40 million US dollars for the pre-production capital, of which the process plant is nearly 50% of the total cost. Again, I can maybe just go one level deeper into explaining the methodology followed in this, because there is often, questions if a capital estimate is lower than what people expected. So we selected the tenderers based on local availability, very importantly, not only local contractors, but ability to work in Malawi, and their ability to design and construct with execution experience in Africa particularly. Site inspections by all the key tenderers, post-tender meetings conducted, further negotiation, and the capital cost generally represent the average of 3 lowest bidders. So we haven't just plugged in the lowest bidder in all cases into these numbers. Does it is upside on these numbers? Potentially, but it's something that as CEO that I can absolutely bank on at the moment. So I feel very comfortable with the growth and contingency that we've included of around 12.5% of total cost. We've added that $4.5 million to accommodate any known unknowns or unknown unknowns that come up in the future. Thank you, Alex. This is very important. Publicly available information. We believe Kangankunde will be one of the lowest capital cost developments of global rare earth projects. We're listing a few of the others there. Now, admittedly, I have to add some of them, like ARU and ASM, they go further downstream. They develop, the carbonate, and in some cases, they're touching on the separation side as well. So it is not 100% like for like, but that is the implementation capex published by these companies. Those are the capex numbers that they say they need to develop their projects. In some cases, the audience should remember, they cannot stop at the concentrate phase. If your concentrate quality is of a certain nature, high radioactivity, or you have phosphates in it also, you have to push on. You have to go through the carbonate phase and sometimes even further. So I think if you look at it from in that context, this is sort of a like-for-like comparison that we are drawing here, and it shows an incredibly competitive position for Kangankunde. Thank you, Alex. Again, this one brings together both net present value and capex. So if you consider that as the return on capital, then again, Lindian Kangankunde is outstanding. It is 13.5 times the NPV capex multiple, meaning our capital cost is only $40 million US dollars, and our NPV is $550 million US dollars, so a multiple of 13.5, whereas most of the others are much lower in that sense. Next slide. I'll touch on the operating cost. Again, ultimately, after the capex, this is what will determine profitability for long-term shareholders over the next few years. You can again see the different categories. Processing, as was in the capex, processing makes up the largest proportion of of the operating costs, around about 30%. If we break this down further, then labor and fuel across the whole project area are the two areas that are most sensitive to changes in market prices and so on. Interestingly, you may notice there that the royalties is around 18%, which sounds exceptionally high for any project to say you will pay 18% royalties. But it is a reminder that because of the low cost structure, royalties are normally paid as a percentage of gross revenue. So you have a high revenue number, and then you pay 5% of that on royalties. But you have a very low cost structure, so the royalties is actually ultimately a big percentage of your cost, which is interesting, and something that I haven't encountered in not one of the 30 projects that I have worked on before, that royalties of cost, the percentage of cost is so high. Next slide, please. So this is where Kangankunde will be situated on the global cost curve. Now, we specifically provided our cost to independent group called Project Blue, independent company based in London, and they ran the numbers through their database of published for rare earth companies. The only way they do it on a like-for-like basis is to convert cost to a carbonate phase, because many of the producers produce at the carbonate level, not at the concentrate level. And that's why you can see us, our cost has been broken up there into the concentrate phase, and then the blue bit is the notional cost that it will take to convert our concentrate to carbonates. Now, in that sense, we are at the very low end. Arguably, if we only go to the concentrate stage, we will be probably in the lowest of tens and tens of rare earth supply globally. So a very, very competitive picture there, again, that investors can take comfort in terms of price cycle, where our $2.92 or our $3.70 all-in sustaining cost per kilogram rare earth oxide, where that will sit competitively. Next slide, please. So quickly, the market and offtake. This again, as I said at the start, we are very confident about the growth potential, the demand growth for NdPr units. Strong growth over the last decade and a half. We believe, not only we believe, but most of the experts' consensus is that there will be another doubling in the next decade and maybe a tripling of demand in the next 20 to 30 years. Next slide. This slide shows lots of lines. The teal color blue line, the thick one at the bottom of the right, on the right side, that is the Lindian price assumption that we are making. I believe it's a very credible price assumption. It is lower than consensus by all these brokers that we list there. We are using the Project Blue price assumptions in general. What's very important for the audience, and a question that I often get, is, are you just using 110 or 120 US dollars per kilogram NdPr price for the life of mine? No. If we start production end of next year, we are starting basically at the spot prices, and you'll see there in the subheading, I'm saying US dollars 82 for year 1 to 5, and then life of mine US dollars 109. I think that is a very realistic and credible picture for investors to accept. Next slide. In terms of marketing strategy, very important. This was my bread and butter in many other roles that I had in my career. The product strategy, as I highlighted throughout this presentation, we will have a premium concentrate. It's top quartile REO grade, low impurity levels, and ultra low radioactivity. Placement of bottom, we have a diversification objective. We obviously don't want to focus all our sales into one market, but very importantly, the low radioactivity opens possibilities in all markets. We can ship this concentrate to most markets globally, and they won't reject it. This is very different to many other producers' concentrates where, because of radioactivity, they can't ship it to other countries. And a good example, very public example, is the Linus concentrate that cannot be shipped any longer to Malaysia, and they had to build their hydromet plant in Kalgoorlie to accommodate that and remove the radioactivity for shipping the carbonate to Malaysia for separation. So we have that ultra flexibility with our product. There's a notional distribution target list there, but time will tell, how it ultimately turns out. On the top right, we believe there's a price premium due to the quality, and that there's a lower processing cost due to the favorable mineralogy. Therefore, I make the strong case that our payability will be higher than the average peer group. It doesn't mean, as we've published in the feasibility study, life of mine 64% payability. We're not saying that is going to happen at all prices, but at $110 per kilogram, that is very likely to be the payability at around 64. At the current spot prices, because payability is linked to pricing, at the current spot prices, of course, payability will be much lower. So we are not playing any games with that number, and we have a robust methodology to calculate what we assume the payability will be. The offtake contract strategy, we have the contract with Gerald Metals, a US-based group, 40% of the 5-year production. If our strategy is fixed, we can have a second offtaker with another 40% for 5 years. And then I think it's always important for players entering the market to also be exposed to the spot market. So reserve around 20% of annual production to sell as spot. Next slide, please. The financial evaluation. The numbers are very compelling, as I said in the first slide, the summary slide. We will have very strong EBITDAs of, as you see there, 1 to 5, 53 million per year. And sorry, life of mine is $83 million US and 124 million per year Australian dollars. Very strong NPVs in both US and Australian dollar terms. And then the payback period, 1.5 years. That looks like, in the good days, a very high-grade gold project of 1.5 years payback. Very, unlikely to see that in any rare earths or even any other base metal project these days. Very importantly, a point that I can't stress enough, the profitability at current low prices. Even at that column where we say spot price, $50 per kilogram, which is around the current spot price, our EBITDA is 11 million US per annum. At the year 1 to 5, assumed price of 82, you will see there 50 million US per annum, and then the long run price as 83 million US per annum. So extremely healthy even at the current prices. Thanks, Alex. The project is very, very insensitive the project NPV is very insensitive to movements in most of the issues of recovery, grade, OPEX, grade, CAPEX. I mean, if you look at that bottom row where we say CAPEX, a 20% change to the $40 million assumption make a very, very small dent in the NPV of pre-tax US $800 million. So you can see the OPEX, again, not large. It's like often price is the main swing factor in the economic viability of this project. Of course, the discount rate always makes a difference, but it is mostly about price. Next slide. So in terms of funding, we've spoken about the pre-production capital cost, which is presented there in the dark blue bar in the pie chart. It is important for transparency's sake that the audience should also always remember when we develop these projects, it's not only the capital costs that need to be funded, there are other costs involved as well. This picture deals broadly with the next 18 months. It's very important to realize that it doesn't mean we need, the $60 to $70 million today to start the project. That is not our approach, and the chairman and I agree strongly with that. For example, the vendor payment, which is the grey bar, the grey pie slice in that pie, that is another $10 million US. It is only really required to be made at the start of commercial production, which in our timeline you will see is late 2025 or early 2026 only. So this is just to give the audience a snap of the funding task. There's corporate cost. We are absolutely dedicated to a Kangankunde Stage 2 study to expand the project. And there's always, very importantly, that some people forget, the pre-production as we ramp up into commissioning and into a real production. So a picture there that still says, not hundreds of millions of capital needed or funding needed. We believe $60 to $70 million in the next 18 months. Next slide. The development schedule. We are highlighting a few points there. Funding confirmation to happen in this quarter 3 2024, the third row there. We are very confident. The team under the leadership of the chairman have developed a number of very interesting funding propositions. We are now going to the next level now that the feasibility study has been published to discuss with people the details. We are focusing initially on construction company funding, on prepayment by off-takers, etc. We are confident we can bring in the necessary funding with a focus on getting enough funding in to award the major construction contracts, to cover the cost of the major construction contracts and get construction going in Q4 this year, as indicated on that chart. Then really the procurement and construction period, which arguably is already starting, given that we have limited notice to proceed contracts already with the design parties. We believe that there could be a 12 months construction period, and that can take us to commissioning and first product by the end of 2025, with potential revenue then coming in Q1 of 2026. Next slide. Again, a competitive position that this project has, based all again on public information, as is in the ASX slides that we lodged this morning. There are detailed that I'm not necessarily presenting this morning at the webinar, but there are appendices to that slide pack that shows all the sources for making these assumptions. We believe we're 15 months from the point of FID to production, and based on public information, most of the other projects are significantly longer than that. Next slide. So, in conclusion, this is a slide that shows the resource endowment of Kangankunde. We are very confident that the 23 billion ore reserves can become a much, much bigger number in the future. We are confident, just looking at concept numbers, that this project, the resource can sustain a project 3-4 times bigger than what we are currently planning to introduce. So if you have the resource, you have the funding support from the market, and you have government support for approvals, you are in a good position to take this project forward through an expansion phase. That is the vision of the company, to become the second largest Western world producer of high quality rare earths in the next 10 years. In conclusion, the next slide, again, reflecting on the 3 messages that I said at the start. We believe the market is strong. At the top left, we believe this is a tier 1 asset. There is no better project in terms of capex and opex for investors to consider. Return on investment, excellent. We are fully permitted, and it's scalable. We can become a very big player in this market. Thank you very much.
Thanks very much, Alvain. We have had a couple of questions come through during the course of the webinar. So the first one, Alvain, the price assumptions that you've used for the feasibility study compared to the current NdPr spot price of around US $50 a kilo, it looks high. Could you just comment on that for us?
Yeah, as I highlighted on that pricing slide, that we are not using an arbitrary number. That's the first point. The second point is we are using independent expert reports that we base it on, which are lower than the consensus broker reports published, assumptions made by a group of I think 10 brokers. So I feel we are more conservative in that sense. And very importantly, we are not going to the 109 life of mine price assumption from day one. We are ramping it up in line with the demand forecast from the $50 currently to $82 average year 1 to 5, which means year 1 is probably about 65 assumption. Again, I think it's all very credible and can be defended. Now, in my experience over many years, banks and lenders and so on, they will always make their own price assumptions. This is our price assumption. We feel it's defendable, it's credible, and that is why it's included in the feasibility study.
Alvain, you touched on the payability assumptions during the webinar, but in a similar vein to the previous question, how much confidence do you have in the payability assumptions used for the feasibility study?
You will only know the final payability when you sign the sales contract, and when the product is delivered, the price applicable at that time will actually determine what your payability percentage is. So in broad terms for the audience, rare earths payability is a very opaque concept. There's a long formula, a bit like I tell people in my iron ore days, the 62% iron ore fines benchmark with 2.5% alumina, etc. There was sort of a benchmark price for that. And then there was a premium paid and a discount applied depending on the impurities and so on. very similar here in terms of payability. 50% rare earth oxide concentrate as the baseline. There's assumptions on sulfides, there's assumptions around radioactivity. If you are better than all those baseline assumptions, your payability is better than average. But also at lower prices, at lower NdPr prices, there's a huge shift in that payability percentage. It drops dramatically. And then when the NdPr prices go up, your payability as a percentage of the NdPr price, ironically, also goes disproportionately up. So concentrates normally sell between sort of 40 to 60% payability. If you go further down the carbonate production stage, you can go to 70, 80% payability. And then, of course, if you're into the separation where you have NdPr units separated, you can be at 90 to 100% depending on your quality. Our concentrate will be at the very high end of that payability. We think at the current spot prices, it could be in the high 40s, higher than most others, which are at the low 40s currently. But at the life of mine average of $109 per kilogram, it is at, as we said in the feasibility report, it can be at 64% payability. Again, I feel very confident that it's a credible assumption we have made.
So can you comment on the estimation process to define your CapEx and OpEx numbers, and how certain are these numbers in your view?
I think I broadly covered off on that, during the CapEx slide that I presented. The points that come to mind again that I mentioned, are we've gone through a very competitive process. We have selected the average of the lowest three. Normally we had 3, 4, 5 tender parties, different packages. We've developed those, particularly the process plant, through to a limited notice to proceed, where there's 2 parties already earmarked who are doing detailed design. We will select one of them in the next month or 2 with a conditional award. So we are well down the design certainty path, and therefore we feel those capital cost assumptions are, particularly the fixed price contracts assumptions on the process plant, they are very firm. Of course, civil works is always with these projects more on a rates-based contract, and it depends on the assumptions you provided to the contractor in terms of rock hardness and so on that they need to move. But again, we feel confident those numbers present reality.
Now, Alvain, given how far the West, given how far the West is behind China in establishing reliable long-term supply of rare earths, in your opinion, why aren't Western governments banging your door down? As you've said, this is a huge resource endowment, and we're just surprised that this resource has not been locked up. What's your view on that?
I think, in my experience, most government agencies and most lenders and investors remain cautious about projects at the exploration phase. This is more a exploration play at that stage, where people just talk about resources. But when you start publishing reserves, you start publishing feasibility studies where there's production, credible production numbers that make the business case. That is when people are starting to take you more seriously. There have been significant engagement with government agencies, Australia, US, Europe already. I believe that will gain further momentum now that the study's out. And certainly there are many incoming requests by multiple nationalities already to myself and women on participation in the project in various forms. So I think the feasibility study, to be fair, has been published for 2 days. So let's talk again after 2 months. I'm confident the picture will be different.
Thanks, Alvin. Now, you mentioned that you're currently in Malawi as we speak. Have you presented the feasibility study to the ministry and other relevant authorities, and what's the feedback been?
Yeah, we obviously didn't have this detailed level of coverage. We met with Minister Monica on Tuesday morning, and we obviously highlighted the economic feasibility, which is very important to them. They are very, very focused. There was mention of herself and perhaps even the president visiting this part of the country where Kangankunde is located. So we hope that by September, October, when we start construction, we will have significant dignitaries attending that function. But in general, we visited various levels of government, from the minister to the principal secretary to the commissioners, and overall, I'm very impressed with the support and interest they show in this project. Remember, Malawi doesn't have many mining projects like other African countries. There are a few projects. Of course, there was the Paladin uranium project that operated for a few years. But at the moment, there are no big mining projects operating in Malawi. So this one is attracting significant attention at various levels.
Thanks, Alvin. A couple more to finish. The feasibility study highlights a potential return of annual EBITDA of 124.5 million Aussie dollars for stage 1. Can you explain why the market is not valuing Lindian today at substantially more than the current $160 million valuation, or less than 1.5 times the average yearly stage 1 EBITDA, let alone the growth potential for our expansion to stage 2? It just seems that Lindian are quite underrated at this point.
Yes, I would absolutely agree with that. I have to say the vagaries of the market have astounded me over my 14 years as CEO of listed companies. In this case, it is even more astonishing. But again, to be fair, the feasibility study has been released for 2 days now. We have significant investor meetings lined up in the next 2-3 weeks in various parts of the world. We hope that as we tell the story, that people can see we are transparent, that people can believe we are credible, and that this is real. This is a world-class project. This is, in my books, I was, very fortunate to be part of the Hope Downs iron ore project development in Australia, a world-class project, one of the largest now in Australia. There's the Tom Prices. I think Kangankunde will be mentioned in the same breath in the future as some of these large world-class projects. And I'm very proud to be part of it. And I want to tell the story with our chairman to anyone who wants to listen in the next few months.
I guess in a similar vein, Alvin, given, let's address the elephant in the room. We've seen a sell-off in shares over the past 2 days after delivering such incredible numbers. How do we re-rate the stock in your view?
By doing what we say we will do, by delivering on it. I can't speak why people are selling. I guess we did go up 48% on Monday, and yes, there have been a 6% drop Tuesday, but still a very positive result, I think, for many people to be up 30% after 2 days, but not enough. I signed up on the basis my private due diligence. I was confident, we can get to 35 cents and 50 cents within 12-18 months. But it is for investors themselves to make the decision. Why do they not like what they are seeing? All I know is this is these are some of the best numbers that I've seen in any feasibility study in my career. So I have no explanation why people would sell stock at the moment.
And Alvain, just finally, you touched on it briefly again in the webinar, but just to finish off, can you just talk us through current funding options? And although it is early days since the release of the feasibility study, have there been any new interested parties now that these numbers are out?
Yes, I can confirm. When Asimwe and I had dinner last night here in Malawi, his phone never stops ringing. There are incoming interest from all sources all the time. We have sources well developed, of course, that we are focusing on at the moment. We have appointed an advisor in Perth who's helping us working through the options, putting some structure against it. We will have a data room in place in 2 or 3 weeks to help with the process. So we are now getting organized. We have the numbers. And I think now those parties, the selected parties that we will allow, we're not going to just hand out the 500-page feasibility study to everyone who asks, but we will select the parties that we believe we can work with. And I'm confident that will lead to a funding result in the medium term.
Fantastic, Alvain. Well, look, that's all the time we have today. Thank you all for joining me. I understand we've had a very, very strong turnout, which is fantastic. I also like to thank Alvain for presenting and taking the time to answer some questions all the way from Malawi. As I mentioned before, a recording of the webinar will be on Lindian's website and social media platforms later today. Alvain, before I let you go, did you have any final comments to leave with us?
Thank you very much to the audience. I can now come out from, I'm inside a mosquito tent, as you can see there in the background. So I will be heading off to a community meeting. I appreciate your attention and time this morning.
Well, that wraps it up for us here. Thank you, everyone. Have a great day.